Today's episode is brought to you by Curve, a card and digital wallet service. You'll be hearing more about Curve later on, but for now, let's get into today's interview. I am joined by Colby Smith, U.S. economics editor for the Financial Times. Colby does a lot of reporting on the Federal Reserve. We're recording the morning of January 31st, and tomorrow, on the 1st of February, Colby will be in the Federal Reserve press conference and asking Fed Chair Jay Powell a question. So I am really glad to have her here. Colby, welcome. How are you doing?
Thanks for having me. I'm doing good. Thanks.
Glad to hear. So Colby, I want to know, what do you think tomorrow's meeting will be? What is sort of your expectation? And also, what will you be, what is on your radar that you'll be on the lookout for, that when it happens, you'll say, aha?
So everyone's really expecting a quarter point interest rate increase. That's been well telegraphed by a variety of Fed officials. So it seems like, we're going to get this step down once again from the pretty large interest rate increases that have come to be a common occurrence just in the last year or so from the Fed. But we're now returning to a more normal cadence of interest rate tightening. But I think the kind of more interesting aspect of tomorrow's meeting and rate decision is really going to be, what the Fed signals about what's coming next. So how many more 25 basis point interest rate increases can we expect, this year? How close is the Fed to wrapping up what has become, one of the most aggressive campaigns in its history to raise interest rates? Have they softened their view at all on the terminal rate needing to rise above 5% for no cuts, to be in play for the entirety of the year? And how they're really taking in all this additional economic data that we've received in the intermeeting period, which shows, a more mixed picture. We don't yet have this cohesive story of a weakening economy, but we're getting quite close to that. And so it'd be interesting to see kind of what they're taking in and how they're kind of digesting all this new information and then what it then means for, the policy path forward. So in terms of, specifically the way in which they're going to be signaling some of this, we're obviously going to be hearing from Chair Powell at 2:30 in the press conference, as you mentioned, but everyone's going to be dissecting around 2 p.m. The policy statement that's going to come alongside the rate decision. Now, in the past couple of months, and pretty much since the Fed first started raising interest rates in this tightening cycle back in March of last year, they've had this phrase, the FOMC anticipates that ongoing increases in the target range, is going to be appropriate in order for basically, rates to reach a sufficiently restrictive level, and then, which will help bring inflation back down to 2%. And so the big speculation ahead of this meeting is, what do they do with that language? Now that we're kind of nearing the end point, do they remove ongoing altogether? Do they change it to further tightening or additional increases? There's a couple of variations that have been thrown around. But I think the real question is, do they want to change the language at a moment in time when they're not quite sure how much more to do? Because if they prematurely change the language, it could kick off another round of easing financial conditions, which is something that they're obviously keeping a close eye on, and it could signal too early perhaps that they're readying for a pause. But if they don't change the language, I think some people are going to say, well, this statement feels a little bit stale. It's not reflecting the fact that we've had significant progress in the data over the coming months. So it'll be interesting to see how, the Fed squares these two things. One way they could do it is to change that language about ongoing increases, but include something in there about the very high bar for rate cuts. So they could do that by saying, rates need to be held at a sufficiently restrictive level for some time, which is what we've heard from Fed officials, quite frequently and across the dovish, hawkish spectrum, basically, in the past couple months or so. So those are just a couple of things that are top of mind.
Thanks, Colby. So, a year ago, interest rates were at 0%. Now the upper range for the Fed target range is 4.5%. Tomorrow, they're going to hike it by 25 basis points to 4.75%. At every single FOMC meeting in the statement released at 2 p.m., and later, 30 minutes later in the press conference, which you've attended, the Federal Reserve indicates we expect that, as you say, ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So if that exact sentence is in the statement tomorrow, it is extremely likely that there will be another 25 basis points increase in March, which would bring the target range, the upper target range, up to 5.0%, which is where I think a handful, maybe two or three of the forecasters were in the SEP summary of economic projections, the dot plot. A lot of those dot plots were in 5% to 5.25%, which would be another increase in June. What does your gut say about the language, and can you also share just how thoughtfully the Fed crafts these statements to be dissected by people such as yourself, and how if there is a change, it's a willful, it is intentional?
Yeah, absolutely. So I think what's important to note is in the dot plot back in December, only 2 of the 19 officials had rates topping out below 5%. 17, so the vast majority of the committee was of the view that it was going to have to surpass 5%. And in the intermeeting period, we haven't really heard much of a divergence in those views from officials. So I think that if, in the intermeeting period, we had heard someone like Governor Waller or someone like, President Bullard, some of these, more hawkish leaning officials talking a little bit more about, the need to slow or to consider lags in the policy changes and things like that, then I think it would have tipped the hand a little bit to there being a more substantive shift in the statement. Now, that's not to say that, they don't acknowledge the fact that there's been progress. Governor Waller had one of the most notable speeches of the intermeeting period right before the blackout, actually, on that Friday. And he said, he made the case for cautious optimism about, what's been going on in the economic data. So they're acknowledging that things are a little bit different and they don't have to perhaps be as aggressive in their posture. But I think the thing that I hear most often is that, they need to do this in a really kind of thoughtful way, because if they tip their hand too early to signal a pause at a time when, financial market participants are already kind of questioning how much further they're going to raise interest rates, if you look at Fed funds futures pricing, we see that, the terminal rate is wagered to top out below 5%, and there's going to be 2 cuts by year end, or 50 basis points worth of cuts rather, by year end. That's, directly at odds with what Fed officials have said. So at a moment where there is this divergence, where they're clearly concerned about financial conditions easing, where the data, is still not telling this cohesive story, I think that there is this sentiment among people that I speak to that it's just premature to make any substantive change at this stage. Now, as I mentioned, there are ways to kind of thread the needle and acknowledge the fact that they're kind of nearing the end here. But it's really kind of a toss-up as to whether or not they want to open that can of worms, basically at a moment when financial conditions are already easing. And the reason why they're so fixated on financial conditions is because it's critical to the transmission of their monetary policy. So we heard this from Chair Powell back at the December press conference. He says it's important that financial conditions, reflect the policy restraint that the Fed is putting into place. We heard this in the December minutes of the minutes from the December meeting, where officials talked about, being concerned about an unwarranted easing of financial conditions, and one that reflects, a misperception about the Fed's reaction function. And I've spoken to, several former officials, including, Dennis Lockhart of the Atlanta Fed, Don Cohn, the former vice chair. And all of them say that, a critical component of the way in which the Fed, gets the economic outcome it's striving for is for, financial markets and to be aligned with kind of, where they think policy is going to go. Taking that all together, it kind of seems as though it might be premature to make any, real adjustments to the statement. But again, I mean, there's a lot of, good points on either end of that.
Right. So financial conditions, part of the financial conditions index is risk-free interest rates, which on the short end, the Federal Reserve has ostensibly complete control of. But then there's also the dollar, there's credit spreads, and there's equity valuations. And we've been in a pretty risk-on mood with stocks going up, credit spreads narrowing, and the dollar having weakened. And actually, I think the S&P 500 is higher now than it was the day that the Federal Reserve did its first 75 basis point hike in June, which is pretty remarkable to me. And actually, that the disconnect between the hawkishness of the Federal Reserve and the optimism of markets, particularly pricing in those forward cuts in the future, which is very interesting. That was of such note to journalists that actually it was in the December FOMC. The first question was about that disconnect between financial conditions. And I think it was asked by Steve Leisman, and Powell sort of dodged it, somewhat nimbly. I mean, do you think that question now will be asked again tomorrow, and perhaps will it be asked by you?
Well, I think it has to be asked, whether it's by me or not, but I think it will be. And that's just because, the Fed has highlighted this as an important, tool for them in terms of making sure, that they're on the way to getting inflation back down to 2%. So at this point, if in December they're talking about an unwarranted easing of financial conditions, well, financial conditions have only loosened more since that point. So if they're worried about it in December, it only is natural that, there would be some concern that level of, attention on these moves, increases as well. I think one important caveat is that the Fed typically pays closest attention to mortgage rates. Those have, perhaps not fallen as significantly, or have the descent, I guess, in mortgage rates has not been as quick and of such a great magnitude as, let's say, the rally in some risky assets or the narrowing of credit spreads and things like that. But at the end of the day, you look at mortgage rates and they're about a full percentage point lower than they were in the fall. And that's not something necessarily the Fed really wants to see if they're trying to, tame demand, especially in the housing sector. And if you look at kind of new home sales and things like that, economists that follow this, they say, it looks like they kind of bottomed out at the end of the year and they're starting to kind of firm a little bit. And that's not perhaps necessarily something you want to see if the overall, direction of travel you want inflation to go is down.
Right. And a lot of these loosening of financial conditions have to do with the forward cuts that are priced in. You mentioned 2 cuts priced in for just this year, just for ending on December 2023, and I think up to 7 cuts by the end of December 2024. The Federal Reserve's line is, we are not even thinking about cutting interest rates this year. However, in the summary of economic projections, they do show a somewhat moderation in 24 and 25. And actually, I think you had an excellent question in the September FOMC meeting where you asked about how in the summary of economic projections in September, core inflation by the Fed was projected to decline. However, there was rate cuts in the on the dot plot. So it's sort of the Fed is having the Fed's own curve is somewhat inverted. Do you think that inversion of that the Federal Reserve sort of indicated on the dot plot that they would cut is what gave the markets such confidence to sort of move those forward rates down?
So there are 2 narratives going on here. I mean, I think the first is either you think that the Fed is going to over tighten and push down demand excessively, cool the economy too much, and that's going to lead to a recession. And that's why there's such substantive cuts priced in basically from end 2023 onwards. But another narrative that I've also heard is that the inflation forecasts and expectations are just a lot more benign than what the Fed currently thinks. We heard that from Governor Waller. He said, markets think that inflation is just going to go, drop like a stone. It's going to be pretty painless, and we're going to not have to be as restrictive as possible. And his point of view is, I really don't think that that's the way things are going to play out. So there seems to be kind of a fundamental disconnect between both the way in which the economy is going to evolve over the next 12 months or so. And then second to that, I think there's also a miscommunication, or a misperception rather, about the Fed's reaction function. So most people assume that at the first sign of labor market softening or a rise in the unemployment rate, that they're going to immediately start to ease, because that's what they've done in the past. And it's easy to kind of take past experience and lay it on to the current moment. But I think what we've learned in the last 12 months or so is that the Fed has kind of thrown out the playbook in terms of how it approaches, a problem like this, just given that, this is, we have a pandemic, we have the war in Ukraine. These are not kind of normal, events and circumstances that, we typically deal with. And so, this rate tightening and in turn rate easing cycle might look different than it has in the past. But I think fundamentally, there's a lot of time between now and the end of the year. And the Fed has said consistently that they're data dependent. Right now, it just doesn't serve them to say anything other than they're going to keep rates elevated for an extended period of time. So much so that some people even think they're going to add that to the statement this time around, that rates need to be kind of restrictive for some time in order to get inflation down. But a lot could change in the next couple months or so, obviously, if the data turn more notably. But I think for right now, where it stands, it just doesn't make sense for them to acknowledge that they would even remotely be open to cuts at any point. And the last point on this, and from speaking to some academic economists as well, there's a lot of fears, and we hear this from the IMF too, there's a lot of fears of a more fragmented global economy, one where there's less globalization, there are more trade disputes, there are a number of kind of supply related issues that could rev up. And so in that environment where, there could be more, consistent price pressures, does it make sense in an environment where there is a, quote unquote, soft landing in the US for the Fed to really be, cutting interest rates? So those are just a couple of factors I think that people are going to be thinking about, but there's definitely this disconnect that the Fed has to grapple with.
Absolutely. And I would say there's a disconnect between the bond market and the stock market, because the stock market is forecasting a soft landing, and that earnings will grow modestly, but not decline. Whereas the forward rates curve is forecasting cuts. In my book, I think the only situation in which the Federal Reserve would cut is a pretty severe recession that takes the Federal Reserve by surprise. I have a hard time seeing the unemployment rate staying below 4%, and the soft landing, and the Federal Reserve cutting interest rates just because they want to help the stock market out. Do you have a similar read or a different read?
Yeah, no, I mean, the threshold, I think, for pain is a lot higher here when they're dealing with, an inflation shock as big as the one that we're currently in at the moment. Governor Waller, this was actually a couple months back, but had an interesting point that, the Fed doesn't really face a trade-off in terms of fighting inflation until the unemployment rate is somewhere around 5%. I mean, we're at 3.5. I mean, that's a significant jump from here. And most economists say a full percentage point, increase in the unemployment rate, that, very much dictates a recession. But ultimately, Governor Waller, I think, has it right that that's kind of like the pain threshold when they start to have to think a little bit more about the employment side of their mandate, rather than just, being so chiefly focused on the inflation, getting inflation down.
Right. Well, I definitely want to ask you about the economic data that's come out of the past few months. But first, just my own curiosity, I have to ask. Having been in all of these conferences, what has the sort of vibe been like? And let's say at the I think March 2022, which is the first rate hike and really sort of the beginning, and March was more hawkish than January, May was more hawkish than March, June was more hawkish than May. What was that process like? And sort of, were you taken by surprise? Also, do you think that in the March meeting, Powell knew that interest rates would be going north of 3-4%, or do you think that the Federal Reserve was just as surprised as everyone else?
I mean, we definitely did not get a sense in March that this is how, excessive that, the Fed was going to be in terms of raising borrowing costs. I mean, even if you look at, the dot plot, the expectations for, the rates by year end in 22 or even 2023 were vastly different than where we are now. And I think at the time, once we got to the May meeting, and the Fed had increased, rates by 50 basis points, we were hearing that, okay, maybe a couple more 50 basis points would be in play. There was no kind of talk about 75. And I think at the May meeting when he was asked, he said 75 was perhaps, not on the table at the current moment. Of course, come June, they're doing 75s. And they've dramatically increased, the dots in the dot plot. And then over the summer, we had this kind of debate of, do they even go for 100? When we got some of those terrible inflation reports, I remember the CPI coming in at around 9.1% on a year-over-year basis, and everyone is suddenly like, 75 isn't going to cut it. They just need to get to a higher level and get there quickly. So the sense of kind of drama and intensity definitely increased significantly over the course of the year. And I think, something that's an interesting, thing to remember is back in March, right before the meeting and the rate decision, it was when, Russia invaded Ukraine. And usually in periods of very significant geopolitical uncertainty, the Fed tends to kind of hold back. It goes a little bit more slowly. It, maybe pauses to take stock of the economic ramifications of something like this. But this time around, it was like, we need to go. We're late on inflation, and there's no point in delaying. And I think if you look at kind of where we were back in March to where we are now, even in the December dot plot, what's so fascinating is that we maybe finally reached the point where the dot plot isn't going to be revised higher from here. If anything, it's going to be revised lower, and that's a completely different set of circumstances than the past 9 months before that, because every time we got that dot plot, that line was moving higher. And the inflation line was kind of still staying too elevated, and the unemployment, expectation was moving up too. So I think there's just been this big sense of, the Fed has kind of finally caught up to where it needs to be. And in terms of the vibe of the room, I mean, I think all of us are just trying to keep up with what the Fed is dishing out in terms of, how quickly they're moving policy. And they got a lot of flack for moving slowly initially, especially with the taper and readying for that first interest rate hike. But ever since they kind of started tightening, they've really kind of kept it up in a way that I think has really surprised a lot of people. I mean, I don't think anyone was assuming that we would get 4 75 basis point hikes last year. And here we are.
Right. Was there ever a time last year where do you think a journalist asked a question that caused Chair Powell to reveal something that he and his colleagues did not plan on revealing? Where they sort of, we got you.
I don't know. I don't know if there's been any, gotcha questions, but I think anytime, Powell has been asked about, the Fed's reaction function or how it's taking in new data, it's always informative for people tuning in here. And I think what has been notable is that they're also kind of sussing this out at the same way that we all are, taking in the incremental data in the intermeeting period and, really kind of assessing where things are. I think that what people kind of perhaps underestimated was just their level of kind of resolve and how quickly they would kind of get going when they really needed to. And I just remember back in the kind of June to July meetings when, people were really questioning them about how fast to go, it became, quite obvious that they were approaching this situation quite seriously. And I think that one moment in particular, I think this was maybe back in the September meeting, there was kind of a question on over tightening versus under tightening fears. That's something that's come up in the minutes quite a lot as well. And, at that point, the Fed has been much more concerned about underdoing it. So not tightening rates enough and letting inflation kind of get out of control, leading to an unanchoring of inflation expectations, versus, overdoing it. And Powell said something along the lines of, well, we know how to kind of deal with a set of circumstances when we overdo it. We can just cut interest rates. It's a much more difficult situation for us to deal with if we, let inflation kind of get out of control. So that was kind of an important tell as to, which way the committee is really leaning here. And I think that's why, anytime anyone, prices in or wagers that the Fed is going to kind of disappoint and or rather back off of, their more hawkish stance, I kind of think back to that moment and realize that, the Fed thinks it can deal with over tightening more than it can deal with under tightening. So it's better to assume that, that's, where they're going to lean.
Right. Can you talk about the process of forward guidance, name of the show, the Fed's transmission of its policy to let the market know what it is planning so that the market can tighten and or loosen financial conditions without the Federal Reserve having to actually do it. And there's the FOMC statement, there's the press conference, what Jay Powell says, there are the speeches of Federal Reserve officials, there's the economic data and market participants guessing about how the Fed is going to react to that. And then there's also journalists who report on the Federal Reserve, and in some cases, perhaps like sort of leak what the Federal Reserve is indicating. I'm particularly curious in sort of when a journalist has a scoop and that scoop sort of moves markets.
So, I mean, the Fed has, as you mentioned, a ton of tools in which it can express its policy views and get its views out there. I think what's notable is that, what central banks, not just, the central bank in the US, but also, in the ECB and around the world, in July, they kind of said, we're going to back off from forward guidance. We don't want to give these kind of incremental, signals about what we're going to do in our immediate next move. It's gotten them into trouble in the past. I mean, we saw that with Chair Powell just over the late spring, early summer. He says 75 is not being considered. We go to 75 in June. He says, he doesn't expect this to be a normal process. We have 4 of them. I mean, it just became, just a losing game, really, to kind of prejudge the meeting. So come July, he was saying, we're not going to do explicit forward guidance anymore. It just doesn't serve the purpose. Now, of course, the big counterpoint there is that, a bunch of Fed speakers come out, in the week after that meeting and talk about their views on the outlook. We get the Jackson Hole speech. We get the SEP in September. So these are the ways really that I think the Fed can communicate where it's going. I think what's been more notable, though, however, about this tightening cycle than past ones is the fact that some of these meetings are more, quote unquote, live than I think people assumed or was.
And sorry, Colby, what do you mean by that? What is a live meeting?
Well, it's essentially where, the rate decision is still kind of up for debate to a certain extent. They don't kind of explicitly know, let's say, or they don't explicitly publicly endorse, let's say, a rate decision. And what was happening over the summer was that, the data was coming in so strong, so unexpectedly strong and so quickly that incremental data points. And I know the Fed says they don't look at one data point, they look at a series, but there were moments in time when, specific data points fundamentally shifted how much, the Fed really thought it needed to do. I mean, that's exactly, what happened before the June meeting. when they, had previously signaled 50 and ended up going with 75. There was that, terrible inflation report. There was another report on inflation expectations as well. That was
on the Friday before the Fed
Yeah.
meeting. Yeah.
Yeah, exactly. And right now we've been getting data releases, just the way that the economic calendar operates. We, in December, we got the CPI report on the Tuesday before the rate decision that came in softer than expectations. And, Nick at the Wall Street Journal asked, would you have delivered the same SEP if you had gotten the CPI, a week ago? Because the assumption is that, over the weekend, they've are coming to, grips with how much they're going to do in their forecasts, and they're not really changing anything that dramatically. But as Powell said then, and I think has proven true throughout the year, is they're taking in every possible piece of information at their disposal before that, the meeting on the rates on Wednesday morning, and before the decision is announced at 2. Take today, for example. We got ECI. I don't think that's, dramatically changing the direction of travel for the Fed, but they're taking that number in stock as they kind of decide, not, of course, the quarter point increase, which I think is widely anticipated, but how hard do they lean in the hawkish direction at the press conference or in the statement if we have another sign that kind of the wages are rolling over to a certain extent and weakening. So as Powell has said again and again, this past year has been one where the Fed has been really nimble. And I think that's kind of shown up in the way they've handled, sharing their guidance and also changing it in real time.
Hey there, I hope you're enjoying today's show. Just wanted to let you know that this episode is sponsored by Curve, a payment service that gives you power over your finances. The way it works is that Curve is an extra layer on top of your credit and debit cards that gives you additional cash back on the rewards that you're already earning. Curve Card has no foreign transaction fees, and you can choose to earn your rewards in crypto. You don't have to, but you have the option. Curve Card also has a feature called Go Back in Time, where you can retroactively change the card used to buy an item after you made the purchase, up to 30 days after, actually. A key concept in finance is optionality. When you have the option to do something, but you don't have to do something, this can be very valuable in finance as well as life. And optionality is exactly what Curve gives you to do with your wallet. So check out Curve to get $20 once you've downloaded the app and made your first transaction. Curve Card is powered by Hatch Bank. Terms and conditions apply. Now, let's get back to the interview. Yeah, so I feel like throughout 2022, the Fed said that they're not going to do forward guidance, but I feel like it's a habit that's hard for them to kick. And actually, I was, wanted to learn more about the Powell pivot in very early 2019 in response to the December 2018 FOMC meeting. So I actually was reading, Nick from the Wall Street Journal, who you sit next to at the press conferences, his stories from December 2018. And in there, they said the Federal Reserve says it's going to no longer do forward guidance 4 years ago. Yeah. So it's tough for them to kick. The employment cost index came in today, I think 1% quarter over quarter on an annualized rate. So that's, I think, slightly over 4%.
Yeah.
Now let's turn to the data. What do you think has been the most significant pieces of economic data? There's inflation, and of course, headline CPI has fallen dramatically because of oil, natural gas, as well as other commodity prices. But to what degree is core inflation, and particularly wage inflation or wage increases, which some argue is a key input and very related to inflation, have remained sort of resilient? So to what degree would people say, oh my God, inflation has fallen from 9% to 7%, 6%, and therefore the Fed's pivot is 3%, here we come. To what degree is that reasoning somewhat flawed, or not flawed, just incorrect?
So, I mean, I think, to take a step back, I think in the aggregate, you look at the data and I think it's hard to point to anything other than the situation being mixed. And that's exactly what, John Williams over at the New York Fed said in his final public appearance before the blackout period ahead of this meeting. And essentially, I mean, yes, if you look at the headline figures, great. We see inflation rolling over. But I think what is critical for the Fed in particular is they're looking at, they're stripping out a lot of the stuff that they expect to fall. So, they care about energy prices, but they've been descending. So they strip it out of their kind of key measure of underlying inflation. The same is true for housing. Shelter costs, those rose quite significantly. Housing, rent, things like that. And then they rolled over dramatically in the latter half of 2022 as mortgage rates spiked. But that takes a lot of time to show up in the data. So, it's been, an important driver of inflation just in most recent the prints, but people are expecting in the next couple months or so for housing to really roll over and that to help bring down inflation as well. But the Fed kind of knows all of this to be true. So they're stripping out those kind of inputs and focusing instead specifically on core services ex housing inflation. And that's, what they say is the best gauge of underlying inflation. It reflects, the strength of the labor market in particular. So it's not necessarily that those views are flawed. I mean, I do think it's the direction of travel we're moving in. It's just that it's perhaps premature to say, okay, the Fed has this totally under control. They should pause at the current moment and they should be done raising interest rates and perhaps maybe should be considering easing. I just don't think the data is pointing to that, just yet. I would say that, in terms of where the Fed needs to go, I think the labor market data is actually, most important for them. That's where, they expect to see price pressures, those persistent price pressures. That's where they say they're stemming from. So we've only seen, on the margin, some weakening of the labor market. I mean, Lael Brainerd, the vice chair, pointed to the fact that, average, hours for workers are falling. Temporary help is also falling as well. So I'm paying quite a lot of attention to those metrics because, as she noted in her recent speech, that's kind of the lowest bar for companies that are looking to cut their costs or to be a little bit more proactive about preparing for a coming downturn. So if we're starting to see that in those more temporary measures, it could well be the case that, that's going to precipitate a larger, more pronounced slowdown in labor demand. So I think, things are moving in the right direction, and ECI was, ratified that view. But I just think that, there is this worry that, the data is just, it's a little bit premature just to say, things are good and done and dusted.
Thanks. We talked about the disconnect between what rates are going to be at the end of the year or at the end of 2024 and what the Federal Reserve thinks interest rates will be. But I think the disconnect starts even earlier than that because the market is pricing that the Federal Reserve get to 5% or 4.75% to 5%, and the effective rate will be some 4.9% or somewhere around there because it's in the middle. Whereas, as you said, only 2 of the 19 members thinks that the terminal rate will be below 5%. So do you think the Federal Reserve's view will sort of clash with the market? And I guess in particular, we're talking about a 25 basis point hike, not tomorrow, not in March, but in May, I believe, which would take it to 5.25%, or a 5% to 5.25% range, which is where the bulk of the dots, but not all the dots, were at December.
Yeah, I mean, the thing is that, what the Fed is going to say, and I'm sure they're going to be asked this tomorrow as well, or Powell's going to be asked this tomorrow as well. I mean, he's just going to say it's too far out. I mean, thinking about the May decision, on February 1st is just not going to give them the they're not going to have the clarity they need to kind of know that they're going to kind of ratify that move. I think the reason why people have kind of coalesced around this idea that they could be done after March, it's because of two things. I mean, the data they say will, point to the fact that they can actually pause after doing one more 25 basis point hike. But also they have the tools in place in terms of them being able to issue a dot plot and having the SEP more broadly to back up their calls to indicate that even if they pause, it doesn't mean that they are kind of backing off of their rate, their monetary tightening campaign anytime soon. Meaning, just because they pause, don't price in those cuts or don't think that those cuts are guaranteed by year end. So in terms of the kind of sequence here, I really do think that last May hike that there is a chance that they don't kind of need to follow through with it. And we heard this from some officials as well, in the intermeeting period. They would love not to have to push rates up further than is necessary. They're not going to just plow ahead because that's what they forecasted back in December, that they need to do. But what I do think, so I think that last 25 basis points is less important than people understanding that they do not want to reverse course and ease by year end. If they ease too prematurely and then suddenly, inflation steadies at too elevated of a level that they need to hike again, I mean, that's not something that they want to do either.
Thanks, Colby. And tell us about the individual members. There's Fed Chair Jay Powell. There is Vice Chair Brainard, who is much more on the dovish side. There is Waller, who I know is important, and he's more on the hawkish side. And then the voting members for change for 2023. So, for example, Bullard, St. Louis Fed president, he no longer has a vote on the Fed. And now we have Lori Logan, we have Harker, Goolsbee, and Kashkari. Tell us, who are these incoming members and where do their, not allegiances lie, but what is their orientation? Are they more on the let's get rates up even higher, or are they on the, hey, we can cut 4.75% is good enough for me?
Right. So two of those members are actually, quite new to the Fed. So we don't really have, years of policy making decision and speeches and things like that to go off of. So Austin Goolsbee, he just replaced Charlie Evans over at the Chicago Fed. And I think this is his first meeting. This is his first meeting of the year. The first, of course, that he's a voting member. And we haven't heard from him in kind of public remarks since taking over that role. But the consensus is that he's leaning on the more dovish side. I mean, he used to be a top Democrat economic advisor to the Obama administration. There are, other public statements show that he's kind of quite concerned about the labor market and the employment side of the Fed's mandate. So the initial view is that he is going to be, a more dovish addition to the FOMC. Now, Lori Logan is, a Fed veteran, but she's played a very different role than what she's currently doing as president of the Dallas Fed. She used to run, the SOMA. She was the SOMA manager over at the New York Fed. So she was responsible for all things related to market plumbing, financial market liquidity, things like that. So that's been, incredibly helpful to hear her insights on kind of the whole QT process and balance sheet reduction and things like that. To wrap things up, we have Kashkari, who was once one of the most dovish members of the all of the regional presidents. He was consistently calling for the Fed to move quite slowly in terms of removing accommodation after the initial COVID shock. But he's actually emerged as one of the most hawkish, people now. He came out right in early January and said that he was one of the Fed officials who thought rates should rise above 5.25%. So there was about 7 officials in the last dot plot who wanted rates, not just above 5%, but above 5.25%. And he was one of them. And he's kind of said, we can't back off of this too early. The bias for me is to raise rates more, after a pause rather than just doing nothing at all or cutting. So on balance, I mean, perhaps it's a little bit more of a dovish Fed, but there are some, strong hawkish voices in there as well.
there have been instances at last year's meetings where financial conditions were maybe, let's say, easier and looser than Fed Chair Jay Powell wanted them to be, and where he had some particularly choice moments of kind of, shutting the market down. I think there's a memorable moment from the November FOMC where a reporter incorrectly said that the stock market was actually up, and Fed Chair Jay Powell had a pretty choice reaction to that. Do you think we will get to see that Jay Powell tomorrow?
The expectation is that he's going to lean hawkish, right? I mean, we're not at the hard part yet, which is what Ellen Mead, who was a former top advisor to the Board of Governors, said to me recently. The hard decision whether to throw in that extra 25 is just not there yet. No one kind of expects that they're not going to do anything come the March meeting. That's going to be when, they have to have maybe a more nuanced conversation about what comes next. But for all intents and purposes, the point of this meeting is to make sure that kind of financial conditions don't ease further. And in order to do that, I think Powell has to kind of pair the downshift to 25, any statement changes, things like that, with a pretty stern message that, the Fed isn't letting up here. They're not close. They're not, close to being done, and they're not going to prematurely back off of what they've done so far. So I don't think the tone of the meeting is really going to be all that different than what we've heard in the past. It just doesn't serve them at this point.
Mm-hmm. And then if a journalist asks, which it sounds like it is likely, about rate cuts in the rest of 2023, how likely do you think Jay Powell would be to sort of like tie the Fed to the mast of the terminal rate for the entire year and say no cuts? Because the advantage of that is that financial conditions would perhaps tighten significantly. The downside is, of course, you kind of remove the optionality to actually cut if there is a severe fall in growth and recession and a collapse in inflation. And then if you do sort of not honor that, then of course the Fed credibility is threatened. So what do you think the Fed's willingness is to sort of pledge themselves to no rate cuts? And also, I feel like they already sort of have indicated to it, but it hasn't been a hard pledge, right?
Right. I mean, the thing is that I don't think we're going to hear any declarative statement from Powell on a decision that they're going to be making in, September or November, let's say, of this year. I mean, there's too much that could potentially happen for him to say, 100%, this is what we're going to do come those meetings. What I do think that he's likely to do is to ratify the dot plot delivered in December, which again shows no cuts for 2023. We heard that in the minutes as well. It specifically highlighted no participant thought rate cuts were necessary. We've heard from Fed speakers that they need rates to be elevated for some time. And what could happen is that is, cemented and added to the statement, because right now there's nothing in the statement that talks about the decision about cuts and the bar for that. So that's one way to kind of strengthen the message that they're not going to prematurely reverse course anytime soon. But I mean, when Chair Powell was asked about this in December, he said, our focus right now is figuring out, how much more we need to do. It's not necessarily about cuts. And they're talking about policy decisions as part of, a multi-phase process. And I still think we're so firmly in that first phase, frankly, which is, sussing out how far we are from terminal and reaching terminal. The second phase is, okay, how long do we kind of hold at that level? And the third phase is okay, when do we ease back from there? So I just don't think that Powell is going to kind of prejudge the third phase of that when we're still kind of in the first phase.
Throughout 2022, very few questions at the press conference were asked about the balance sheet. Relatively very few questions were asked about the balance sheet. Well, I guess, let's see, during the second half of 2022, because obviously there's the taper and the tightening. Now that quantitative tightening is sort of running in the background, it's kind of tough for people who aren't very involved to know how the Federal Reserve thinks about quantitative tightening. Do you think that the Federal Reserve is happy that quantitative tightening is serving its goals? Do they think they need to do more? Do they think it's causing problems? And also, do you know why the balance sheet is talked about so much less so than rates? Is it just because interest rates is something easier to comprehend and the balance sheet is more theoretical and sort of hard to understand?
So I think it's a couple of things. I mean, the balance sheet, first and foremost, is not their primary tool. I mean, they said this again and again throughout the process of both providing accommodation and also removing that accommodation, that, the federal funds rate is their primary lever to, exert any kind of pressure or stimulate the economy. So I think they're quite happy that the balance sheet is a secondary kind of consideration for a lot of people. But that's not to say that it's not important. It's an incredibly, it's a pillar of their policy tightening plans. It's just not something that they are, constantly adjusting and making amendments to in the same way that they're doing with the policy rate on a, every 6 weeks or so. So I think they're happy that it's kind of running in the background. I think the question, there's a couple of questions there about, when do they potentially make any changes? Do they, if they pause rate hikes, do they continue on with balance sheet reduction? And it sounds like from, what we've heard from officials that they're comfortable doing that. I think the real unknown is, okay, if they start cutting interest rates, do they cease balance sheet reduction? Because typically the Fed likes its tools to work together and in the same direction. And they don't like, tightening on one end and loosening on the other. That's a hard message to communicate. So that's going to be the big kind of unknown with QT. But I think if you layer on top of everything else that's going on in the US, and I'm thinking specifically about kind of debt ceiling issues, things like that. I mean, if come June, July, they're dealing with the potential US default, I highly doubt that, the QT is going to be running as it is currently. They'd probably have to make some adjustments there as well. So there are a lot of kind of unknowns about QT. I just think the problem is that, as I mentioned in my, earlier, they're in these different phases with the policy rate, and that's why it's garnered the most attention. But that's not to say that, the balance sheet is not going to become, the focus once, we reach a kind of pause in the tightening cycle, and the Fed is thinking about, other ways it can manage, the level of restraint it's exerting on the economy.
Can you explain for me and our audience what's going on with the debt ceiling? What are the salient issues, and how do you think it will be resolved? Or maybe you think it won't be resolved?
I think it will be resolved. I mean, I just don't think that we're necessarily careening towards a default, without there being a considerable amount of effort on all sides to kind of avoid that outcome, which we know, from Treasury Secretary Yellen and any policymaker, frankly, that would be a absolutely disastrous outcome. But I think the thing with the debt ceiling right now, we have, Speaker McCarthy meeting with Biden tomorrow to suss out if there's any kind of deal. The problem is that Biden has said he wants to push forward a clean debt ceiling increase bill, meaning, it doesn't have conditions tied to it. Whereas Republicans, they want to pair any increase in the debt ceiling with spending cuts. So there are some real fundamental differences in the way in which people think that, they can come to some kind of agreement. But they have a little bit of time, thankfully, until the pressure really builds. We all think about this thing called the X date, which is basically the moment in time after all of the Treasury Department's quote unquote extraordinary measures are exhausted. And these are things like ceasing investment in some of their government accounts and things like that in order to carve out a little bit more borrowing capacity. So Chair Yellen has said that those extraordinary measures will run through June. And the expectation is that that X date isn't until later on. That date can move quite a bit. I think the problem is that the closer we get to the X date, the more financial markets are concerned about, there not being a deal. We can start to see short-term bills and other government instruments, pricing a little bit out of step with the rest of the yield curve. And, there could be more volatility, things like that. So this is a major kind of unknown, I think, and could very well create a situation that, requires some kind of response from the Fed or some adjustment to its policy plans at that point.
Is there anything the Federal Reserve can do, or the Treasury can do, or market participants can do to sort of unlock the giant well of liquidity that's somewhat trapped in the reserve repo facility? I think, and as you can tell by my hesitation, I'm not an expert in the plumbing at all, but I think there's close to $3 trillion that is in the Federal Reserve's reverse repo. So it's not a deposit facility, but it's basically like a deposit facility. So people just park their funds there, and that rate is, I think, somewhere between, it's in the ladder of the lower Fed funds rate and the upper Fed funds rate limit. So that level will change tomorrow. But there's trillions of dollars in there. Can that in any way sort of fund the government and do bills? Is there any sort of extension we can get there, or no?
No, not really. I think it's kind of separate from the whole debt ceiling situation. I mean, the thing with the overnight repo facility is that's eligible banking institutions and other money market funds, things like that, stashing cash there kind of overnight. But that's an overnight facility. It's not something that anyone would kind of tap for the purposes of funding the government. Plus, it's only it's $2 trillion, but it's overnight kind of overnight dealings. I think what people are more thinking of is what the Treasury can do in terms of prioritizing payments. So do they, focus, once we get past X date, do they focus on, paying bondholders? So maybe we don't have a technical default, even though that would be really up for debate, I think, with some credit agencies who would say if you're missing payments to, the military or things like that, that still constitutes, not making good on your obligations. The second thing is, and this has been floated in terms of what the Fed can do, is do they buy up defaulted securities, let's say. Chair Powell actually has been quite involved he was at the Fed when these debt ceiling, standoffs have happened in the past. So if you look back to, transcripts in 2011 and 2013, you can hear a broader conversation internally at the Fed about what they think they can and should do in the event of a debt ceiling situation. At the time that, the Fed buying defaulted securities was brought up, Chair Powell, or the Governor Powell at the time, called it loathsome. So it's not something that he supports clearly. Be interesting to see if that view has changed at all. But another important thing to note is the Fed doesn't want to come up with this, plan B if the government defaults. I think that the more contingency planning is in place, at least publicly, the more concern there is that the impetus for policymakers to come to a deal and lawmakers to come to a deal is just going to lessen. It's sometimes the urgency of a financial collapse and financial markets, falling out of bed that forces, I think, people to the negotiating table. So it's kind of it's a really dicey situation. The Fed definitely does not want to be involved in this at all. But those are some of the kind of ideas that have been floated.
Thanks for explaining that, Colby. It's been absolutely great getting you on Forward Guidance. Thank you so much for sharing your insights. Thanks to everyone for watching. We will definitely be watching you and Fed Chair Jay Powell tomorrow. People can find your work at the Financial Times. And of course, they can find you on Twitter at Colby L. Smith. Colby, thanks so much.
Thank you. Appreciate being here.